It's pretty clear, but it's still, we're at a point now that's pivotal. Let me explain why. First off, stock market. Stock market is a bubble. It's the biggest bubble in U.S. stock market history on a percentage basis and on time duration spent on the upside from 2009 low to late last year, okay? Parabolic blow-off market. Sponsored by the Federal Reserve's QEs and monetary growth. So we had inflation. You don't like inflation? Well, that was it. The stock market can be inflated too, okay? But that's okay. They accept that. Okay. Now, so they want to come in and fight inflation. But the problem is that this is not 1980 when gold had just gone up eightfold in price and topped, and that was coincident with Volcker raising rates, which had already been underway prior to him becoming head of the Fed in 1979. But gold had an eightfold gain. Commodities had a doubling over a 3-year period. Stock market was dead flat during that time. So at that time, well, people like to look back and, the Fed broke inflation. Okay. Yes, but those markets had a massive multi-year move. Gold had an eightfold move, and the stock market was dead. So the bubble back then, if you wanted to call it that, was gold. And therefore, it doesn't shock us as a technician that gold peaked back in 1980, and stocks later in 1982 finally woke up and started a bull trend. Now we have a similar situation where people think, Powell's doing a Volcker. He's going to raise rates to stop inflation. The problem is the bubble this time is not the commodity markets. It's not gold. Gold's only doubled over the last 5, 6 years, 7 years, not eightfolded. Commodities have only recently, in the last year or so, turned up. So they're a fresh annual momentum uptrend. And they're clearly not back to their 2011 highs. People don't realize that. You look at the Bloomberg Commodity Index, it's trading in the 120s. Well, it was a lot higher than that in 2011. So yes, it's up. Yes, it's gaining strength. Yes, there's, quote, commodity inflation, but it's nowhere comparable to the 2011 levels. Okay. What is the bubble this time around is the stock market and certain other related asset categories. Other markets that have gone up along with the stock market are muni bonds, high yield corporate debt, and treasury bonds. Treasury bonds, as everybody's seen the charts that technicians have put out, a 30-year uptrend in price, drop in yields. Massively aged. It's broken. Okay. So if you're a portfolio manager and you're looking down at your grid of your portfolio components, you've got the stock market. Well, okay, so far this year to date, let's do it. The S&P is down, I just calculated a few minutes ago, 18% on the year. Okay. NASDAQ 100, the leader index, is down 28% on the year. TLT, which is an ETF for long-term government bonds, 20-year plus duration, is down 20% on the year. Okay. Again, these are asset categories that people like to get into. Okay. High yield corporate debt, down 13% on the year. Muni bonds, down 10% on the year. Okay, what's left? Gold is unchanged on the year. So yes, gold has had a punishing sell-off, somewhat incoincident with the stock market, but it's the only asset category at this moment that is actually up on the year of the major normal, what you call asset categories. Gold being the one that most asset managers would deem to be the alternative. Okay, well, it's performing like an alternative. Okay, now, it's recently been in sync with the stock market. And I say recently, I mean only since about mid-March. Prior to that, it was moving somewhat opposite to the S&P if you look at it even on a daily basis. Okay, now it's somewhat in sync with the stock market. So the question now is, okay, is the stock market going to do another October 2008, where you had a 35% crash late in the bear market, or a March 2020, where you had a 35% drop in a matter of 3 weeks in the S&P, and gold joined coincidentally with that over a 6-day period late in that break. Is gold going to join in with further decline in the stock market? Okay, then the issue becomes, okay, well, is the stock market going to do a crash number on us here, or is potentially at a level where it might actually hold for a while and it could generate a bear market rally, a genuine bear market rally? Okay. Momentum structural analysis declared a major top in the NASDAQ 100 as of the January close of this year. It wasn't very far off the price highs of December at that point. And the February close in the S&P generated an annual momentum long-term trend sell signal in the S&P for us. Shortly after issuing those sell signals, the market dropped into March, then has some bounce. It's now approaching a number on both indexes that we had specified several months ago as a possible point where in the decline, the bear market trend that's now begun, we might actually get a period of pause and a rally, not just a 1 week rally, but maybe even hold on it for a month or two. That number was 3,800 for the S&P, and today we traded into the 3,800s. Okay. For the NASDAQ 100, the number was 11,500 something for this month. It got down to 11,600 today. So both of them got within very close proximity to certain levels that we previously specified as a possible point to stop this particular sell-off, so it doesn't become a crash situation. Okay, so therefore, what we're doing right now, as far as gold is concerned, we're watching the S&P, because since gold is now in sync with the S&P, if the S&P breaks those numbers significantly, if NASDAQ breaks our numbers significantly and indicates no, it's not going to hold where you thought it might, temporarily even, then gold might participate further on the downside. In which case, we could get a replica of that March 2020 event or that October 2008 event. Now, those, by the way, and we've gone back through the history. In fact, I've lived a lot of the history of gold. Of the three crash type events like that, where you drop more than 35% in the S&P in a matter of several weeks, that'd be October 2008, March 2020. There was one other, and it was obviously October 1987. It was a crash that I happened to personally catch. At that time, in the 87 crash, gold exploded. Remember that, okay? It doesn't always crash with the stock market. The last two events are spread a dozen years apart, 2020, 2008, so not many examples of this. So I'll give it the opportunity, if the stock market doesn't hold our support level and drops sharply, and it better do it quickly because otherwise it's not going to do it, then gold might participate. But if you go back to those last two events and study them carefully, the 2008 low in October 2008 and the low in March of 2020, when gold did its tantrum in sympathy with the stock market, it exploded after that. You couldn't buy a pullback. It just rocketed out of the hole. Such that in 2008, for example, the stock market had the crash in October, but it didn't finish really going down until March of the next year. By February of the next year, gold was back to the highs by February of 2009. So it divorced the stock market once that tantrum occurred. Okay, look at March of 2020. The S&P made a crash low then. Gold made a somewhat crash-like low. It wasn't nearly the dimensions of the S&P drop. Within 7 days, gold was back to its high. It took the S&P 5 months to get back to its prior high. Gold rocketed back in 7 trading days. So if we do get an event like that in this particular decline in the stock market, and it drags gold with it, it's a buying opportunity. The question is, are we really going to get that kind of tantrum event where, the word is sell everything? And I don't know. I do know where we need to hold on the stock market, and we're approaching that level now. And frankly, my suspicion is you're going to hold it, in which case gold is going to hold as well. And again, right now, when I look at the tape, gold is up $5, $6 on the year. No other asset in the world is up on the year. Okay. So anyway, that's the context we're looking at right now. Does gold follow a further stock market decline, or is the stock market about ready to put down its foot and say, okay, now that everybody's bearish, that seems to be the sentiment out there, I'm going to have a rally? I don't know the answer, but I know we're in the zone now where the decision is going to be made.
Now, it does seem like kind of the two situations you're looking for is either gold does not have that washout, or it does, and it rallies real quick and makes new highs very quickly. So either way, it seems like right now may be a good, either way right now may be a good buying opportunity.
Yes, I would say that, but I'd like to see, because we can measure the S&P and the NASDAQ, and if they frankly get too much below our projected support levels, which only today did they get down to, None of the other lows of this year even approached our numbers. Only today got there. It might hold. And frankly, I think the clock is on the side of the bulls. If the bears don't do something dramatically, I mean within days, not 2 weeks from now, but if they can't break that S&P and NASDAQ through those levels and take gold down through a number I don't particularly want to see right now, that's 1820. Right now we're 1840 something. Okay. Then they're not going to get their tantrum solved. It's not, those kind of events don't go down and think about it and then break. They just go down. There's no pause. It's just a rip-roaring sell-off. And right now they've got to keep the pressure up on the stock market and the NASDAQ and the S&P in order to drag gold down, or the selling pressure abates. And therefore you've got to watch the tape. That's what we're doing over the next day or two, because frankly, if we stall over the next day or two, I don't think we're going to have further downside. I think we're going to get a normal bear market out of the stock market, which is to say a layered bear market decline, where you shed 20% over 3 months and rally 10 and shed another 20. It's a very confusing process. Crashes are rare in stock bear markets. 1929 is the only one that ever began with a crash. And as we know, March 2020 didn't begin a bear market because we rebounded. So anyway, let's watch the tape very closely over the next 48 trading hours, because I think that's important, because if there's no further sharp follow through in the stock market, my bet is gold's going to hold. And silver, which is the one market this year that MSA has been the most wrong on, but I still think we're going to be right. While gold has held pullback and not even traded down on the year yet, silver has gone down on the year and swept the price lows of the last year and a half of trading. And I urge everybody to go get a silver chart. And like a monthly bar chart or maybe weekly, go back at least to the summer highs of 2020 when silver approached $30. And if you'll notice, about 7 weeks after that high, silver dropped under $22 in a very sharp sell-off. It dropped $8 in a matter of a month or so. It then went back up to 30 in early 2021, came back down, traded under 22 twice last year, but couldn't get down to 21. So you had 3 lows in the last year and a half. Under 22, under 22, under 22. And then we shot up to 27 a month or two ago. And today we traded down finally and blew out all those lows just below 22 by trading down to 21. Okay, that's a price chart breakout. And we don't have much respect for it. But if it's got any potency, it better exploit it now and just collapse. And if it doesn't, it's a trap. It's what we call a bear trap. Meaning you got such an obvious price level in your price charts that everybody looking at one could say, oh my goodness, it broke through the lows of the last year and a half. If it doesn't have any potency and it pushes itself back up into that range, then it's saying, I teased you. That was a buying opportunity. And therefore, we're watching the tape very closely right now.
So what I'm hearing, again, is that if silver does not, if it goes back above that $21, $22 level,
the 22 to 23, it gets back up into that zone again. If gold doesn't break down much, especially if it holds unchanged on the year, if the S&P puts on the brakes and NASDAQ put on the brakes, all right around these zones, then I think you're seeing the end of the event right now. But the caution being still that if the S&P gets out of hand and the NASDAQ gets out of hand, it could in turn continue to drag down gold and silver. And that's the big question, because that's what everybody's focused on, is the implosion of a major asset category and other sympathetic categories, muni bonds, corporate bonds, government bonds. There's only one thing left on the board that's unchanged. It's beating the pants off these other asset categories. Even if it is unchanged on the year, it's still percent-wise vastly beating them just over the last 4.5 months. And you could have, if you'd shorted the S&P at the close of last year and bought gold, you'd be break even on gold and up by 18% on the S&P with a spread position. Think about that. So that's why large asset managers around the world are aware of these things. Regardless of their reasoning as to why they might be, they're aware that gold is holding its value compared to these others. And it's even holding it on a nominal basis versus last year.
And what are some of these price points you'd be looking for if there is a washout in the precious metals?
there's a washout in the S&P and NASDAQ, and they violate our zone of support, which is like, let's call it 1% below today's low in the S&P or so. Much under 3,800 S&P, especially close a week or a month there, wouldn't look good. Okay, so far our low is 3,870 something today. Okay, NASDAQ, our number is about 100 points below today's low. I'd like not to close a month below it, and definitely don't want to close 4% below it, which is to say you don't want to see NASDAQ 100 trade 11,100. That would be too deep on an intra-month basis. Well, that's only 500 points below today's low, and for the NASDAQ, that's a couple percent. Okay, it's not that much NASDAQ 100 I'm talking about. If I see those numbers, it says, oh, they could implode, in which case gold could join in. If gold drops to 1820, so far it's been down to 1830 something. If you drop to 1820, particularly close a week there, I think there's potential for a 10% drop, which is to say low 1600s. Now, believe me, if gold drops another 10, the S&P will have dropped 30, okay? So it'll still be beating those categories. But if we get that kind of drop in gold, I think it'll be a vortex, what we call a vortex low. Meaning when you make that low, when you turn, don't expect it to gradually recover. I'd expect a vacuum above it. The question is, are we going to get that kind of washout? And I have my doubts. The next, I'd say 48, 72 hours should tell the story.
So really we're looking at the close for the week and then maybe Monday, and we'll kind of know, we'll probably have a better idea of whether we're going to see that washout or not.
So today might even help. I mean, if the S&P, which has rallied back, it's rallied 70, 80 points off today's low intraday and then pushed back down again. If they can manage today to come out and close steady, and then you come in tomorrow and there's no washout, then some of the very short-term things we're looking at will start to turn up. Same is true with gold and silver. We look at daily momentum as well, very short-term. And they've got metrics not far above them that if they got up there even tomorrow, it would indicate to us, okay, wipe your brow. We're not going to have the implosion. In which case, all these asset categories will rally. The problem is for the other asset categories, the stock market, the muni bond market, and so forth, the rally is not good. It's a bear market rally. In the case of gold, it's merely you've had another zigzag in an ongoing bull trend. There's a fundamental reason for this. Why gold is in this kind of trend. If you'll go back to the 2008 low, why would gold have had a sympathetic collapse that month, actually within several days and during October of 2008? The S&P continued down until March of 2009, and gold shot back to its high. Why would gold do that? What was on its mind? Go to the March 2020 low. Within 7 days, it was back to its high. It took S&P 5 months to get back there. So gold didn't care about the recovery in both of those cases of the stock market. It just said, okay, wash out over, I'm gone. What was gold anticipating? I think what gold was anticipating is it's a monetary metal, and it knew the Fed would go berserk in both instances. And sure enough, after that 2008 bear market in stocks, the Fed went lunatic for a dozen years. Gold knew it was coming. After the March 2020 low, the Fed went even more lunatic. In fact, the Fed bought outright ETFs of muni bonds that I mentioned, ETFs of high yield corporate debt that I just mentioned. Outright bought them, put them on their balance sheet. Gold knew that was going to happen, that the Fed would panic. Okay, now right now we have a situation where the overwhelming consensus is no, the Fed's not going to care if the stock market turns down. They're fighting inflation. As I explained, this is not 1980. We do not have a commodity bubble or a gold bubble. We have the stock market bubble. So when they tighten, it's bringing down the inflation beneficiary of the prior dozen years, and that's not been commodities and gold. It's been the S&P 500. So the Fed thinks they're doing a Volcker, and they are, but they're doing it on the stock market. And once they realize, and I'm sure they're not really happy with the decline so far in a lot of these categories, because these are the categories they were outright buying in the spring of 2020. And now when they quit buying them, these categories are imploding. These are categories the Fed cannot allow to implode. They can't allow the state governments and municipal governments have the debt problems. They can't allow pension funds to get strung out. They can't allow corporate debt to implode. They can't allow government bonds to implode. And they know if the stock market continues down, even in an arm wrestling manner, you're going to have economic metrics that will get in tune with that very quickly. So all these, quote, good economic numbers that they like to cite will turn negative very quickly. If you listen to what Powell said in his last meeting early this month, or last week, and I suspected he was going to do it. Yes, he's going to go ahead 0.5%, right? Big shoulders out, okay. But he subtly said quite a few times, but we're going to be data sensitive. We're going to be data sensitive. Meaning if something happens that they don't expect on the economic metrics, or maybe the stock market, they're going to be data sensitive and have to change that policy. And I think gold knows that. It knows that if the stock market does continue down, whether it's arduous or collapse, it's going to cause the central banks, not just here, but Europe and Japan, which is still an easy course, Japanese are, to get back in line with each other. You know, they used to have that as sort of a policy, that their policies would be in alignment with each other. Right now, they're spread apart. The Japanese are easy money. They've declared they're not going to change. ECB is somewhere in between, and we're hawks, okay? Well, we start getting the data-sensitive information that Powell kept mentioning, then this so-called upward trajectory of rates is going to end, and gold knows it.
Now, you've mentioned before that if the Fed does reverse, it's going to be very different. The impact to the markets is going to be very different than we've seen in previous years when the Fed has done quantitative easing, expanded the balance sheet. This money creation has gone into the stock market. This time, you're expecting it to go into gold and commodities, correct?
This is what happened in the late 70s is we had a collapse in the stock market between 73 and 74, 50% bear market. Ended in December of 74. The world was in global, they invented the word back then, stagflation. Okay, commodities, gold had already had a bull run to $200 from $30 and peaked in 1975, came back, had a 50% correction, and then began the bull market that ran up to 1980, where it went from $103 low in 1976 to $850 in January of 1980. All during that time, even well before Volcker became head of the Fed funds rate went from 4% to 11% in the middle of that bull trend of gold. And when Volcker came in September of 79, he jumped it up to about 15. And by March of 1980, he raised it to 20. Well, gold had already peaked in January. So all during that upward arc in gold, an eightfold move, interest rates were soaring from 4% to 20. I'm talking Fed funds rate. Gold didn't care. The stock market did what? Laid dead. In fact, you could draw a line sideways after the 74 bear market that was a rally into 1975. And then you could draw a line sideways for the next 7 years and watch the S&P just hover, going nowhere. It was a total wasteland. So it's a totally different situation now. The bubble is no longer gold and commodities in 1980. It's now the stock market. The Fed seems to be thinking that, they can stop commodity inflation, which they don't like. They like stock inflation and muni buys. Okay, we print those prices higher, fine. But when commodities go up, they don't like it. The problem is their policy is going to break a bubble, but it isn't going to be a gold bubble because there isn't a gold bubble. It's a stock bubble, biggest one in history. So they got a real problem, an academic, intellectual problem, and probably a survival problem in terms of central banks, in terms of credibility over the next year or so. And I'm not just talking the Fed, but all of them. Because obviously, especially over the last 50 years, this hasn't worked. We've had repeated boom-bust cycles with monetary sponsoring the boom, markets deflate, they sponsor another one, et cetera. It just goes on and on. Now it's gotten crazy. It's gotten crazy. So anyway, it's going to be a very interesting year, but I think still the prime beneficiary is going to be gold and silver. And I put an emphasis on silver, and I admit we've been wrong about that guy. He's a wild dog compared to gold. It's that way. When gold goes up, silver goes crazy. When gold goes down, silver goes crazy. So anyway, watch for a turn here in these markets. And if we get a turn out of gold, I expect silver to snap back up far greater than gold and take the lead once again.
We'll have to keep a very close eye on the markets in the next couple of days. Michael Oliver, thank you so much for joining us today. If people are interested in learning more and signing up for your newsletter, where can they find you?
olivermsa.com.